A very good morning to everyone. Today I'm going to discuss today's most important article that was published in the Economic Times. So the title of today's article is "The Bankruptcy Code Isn't Broken, but it still needs a fixing." This article is written by two people. First is Arvind Panagariya and second is Rajeev Mantri. So before I really go into the analysis part, I would like to give you the outline of this video or the format of this video. So first I will discuss the context of this video. So for example, the introduction part, basically what this article talks about. Then we will go to the vocabulary part and finally the final analysis. So now coming on to the context part, this article basically discusses the pre and post regime of IBC, that is the Insolvency and Bankruptcy Code, that how things were different before the IBC and how things have changed after the implementation of IBC, and what new amendments could be done or what changes could we bring into the act so that the speed of resolutions get much faster. So now coming on to the vocabulary part, I have able to find only 8 words that I think are important. So first is, so the first word is malaise, which means something that requires or involves a great deal of efforts, trouble or difficulty, something which is very difficult to do. Second is protected, something which cannot be denied or disputed. You can use it in a sentence like my proofs were protected, which means they couldn't be disputed, they were undisputable. Third is unscrupulous. Unscrupulous means clever, basically. Fourth is arduous, something which requires or involves strenuous effort, difficult and tiring, something which is difficult as well as tiring. Fifth is subvert, which means to reduce or undermine the power of authority. Sixth is blunt, which means to make something weaken or to reduce force. Seventh is incumbent, which means something which is necessary to do, like a duty or responsibility. Or eighth is prop, which means to support or keep in position. So before go to the analysis part, I come across with a few terminologies and agency, or you can say organizations, which I think are very important. So first was structured loans. So what is structured loans? Structured loan is basically when a borrower is incapable to pay his loan regularly according to his present repayment schedule and his account continually goes bad, then the repayment period could be extended by to decrease EMI amount. This method to check the irregularity is called restructuring and the loan becomes a structured loan. So basically when a borrower couldn't pay the EMI amount, so what a banks does is that before it actually start entirely defaulting the whole amount of loan, so they restructured the borrower's loan. So what they do is they reduce the EMI amount so that now borrower could afford to actually pay the EMI by increasing or you can say that by extending the repayment period. So that is, so the process which is done to the loan, that loan becomes the restructured loan. Second is written downs. So written down basically counting term, which means to bringing down the book value of an asset to its fair market value. So for example, you can say that let's say in the accounts, in the balance sheet, in accounts there is a machinery call for rupees 40,000, but actually in the market its value is like say 30,000. So if accountant reduces the book value of 40,000 to bring down it to 30,000, which is the current market fair value, this whole process will be known as the written downing of the asset value. Okay. So third is the organization, or you can say the agency, enforcement directorate. It is a law enforcement agency and economic intelligence agency responsible for enforcing economic laws and fighting economic crimes in India. Okay. So these three terms will be used in the article as well, so you must remember this. So he starts the article by giving the few scenarios that were before the actual reforms happened. So he says that until 2015, contrary to international best practice, RBI rules permitted banks to classify restructured loans as standard loans rather than downgrade them to non-performing assets, non-performing status. So what is saying that until 2015, contrary to international best practice, so RBI was not following the best practice that is followed at the global level. So RBI used to permit the banks so that they can classify their restructured loans, the loans that they have restructured, still as a standard assets rather than downgrading them to the NPL level. And second is says that until the IBC was passed in 2015, the process of exit of defaulting firms and recovery of loan from them was cumbersome, costly, and protected. Later on, he goes to explain that fearing that recovery of loan in default would be partial and take a time, bank managers preferred to restructure loan before they went into default. Until the rules restructured loans retain their status as standard assets, the incentive to follow this practice was especially in high public sector banks. So what he's saying is that before actually what bank managers used to do is that before actually the loan, because they knew that if our loan get fault, the recovery will be very cumbersome and will take a lot of time. So what they used to do is that if they get a clue that a particular loan going to be defaulted in the future, so before it actually get defaulted, they used to restructure it loan, because RBI permits that even the restructured loan you can still show in your balance sheet as a standard loan. So that's why they used to do this practice. So and this practice mostly used to done by the public sector bank. So is that since any written down on the loans in the event of default and partial recovery carry the risk of attracting the attention of vigilance agency. So he is saying that why they used to actually restructure the loans, and rather than showing it as a default, they restructure the loans and show it as a standard asset. So they used to do this because if they have to written down the, because if the asset will get at the NPA status, they have to written down the asset or the loan amount. And when if they start reducing the loan value in the balance sheets, they will start attracting the attention from the authorities or the regulatory bodies. So for avoiding their attention, they used to do this malpractice. He says that as a result, a restructured loan with the little process of recovery piled up, especially on the books of PSP. So obviously, because they were keep restructuring the defaulting loan or the possible or the loans which has the possibility of defaulting in the future, and they start piling up the whole default loans in their books. And this again was happening more in public sector bank book. He says that many scrupulous promoters saw in this weakness of the system an opportunity to accumulate personal wealth. They effectively transformed a part of the bank loan into personal equity. This act undermined their ability to service the debt further, but they knew that the bank would have no option but to restructure the loan on more generous terms. Repeated iteration of this process gave rise to what came to know as evergreening of loans. So what he says, that there were few clever promoters who see this loophole as an opportunity to accumulate wealth. So what they did is they used to take a loan or the debt and turn it into the personal equity, and they will not pay the amount for the amount borrowed, because they knew even if they want to pay the amount of loan before the actually loan will go defaulted, bank will still keep on doing the restructuring of the loan, and on a more generous term as well. So they didn't actually had the fear of actually defaulting the loan, and by doing this repetitively, this thing now this whole process has become the what is now called as evergreening of loans. So he says that eventually in 2015 RBI did caught up with this game and changed the regulation to force the banks to reclassify restructured loan as non-performing assets. So in 2015 RBI did catch this game, this loophole that people are playing with, and forced this law that if our loan will get restructured, the bank will have to term it as a non-performing asset. This led to a quick deterioration of a balance sheet of the banks, especially of the PSP. Obviously, that has to happen, which had accounted for this disproportionately large volume of the restructured loan, because obviously because they had actually got piled up so much, and by bringing this law, their balance sheets, basically the balance sheet, mostly the balance sheet of public sector banks start deteriorating. He says that government was left with no option but to commit a gigantic 2.1 trillion rupees in 2017 for recapitalization of public sector bank. Fundamentally, this sum gave relief to corporation and banks despite their mishaps. So what he's saying is that again, after, because public sector banks book start have deteriorating. Okay, so what the government did, this government started infusing, say they actually infused 2.1 trillion rupees in 2017 to actually recapitalize their books, to recapitalize the public sector banks. And since there was no punishment for the corporation and the bank who actually did it for their mishap, and they still got the benefit of fully recovering and didn't got punished for for their malpractices. He says that it amounts to more than 1/5 of the all public welfare direct benefit transfer since 2015-14. So this amount was that much huge. He says that an even more damaging effect of the arduous pre-IBC regime was that it subverted the process of creative destruction by throwing sand in the wheel of market renewal. Difficulty of exit discourage entry of new vibrant firms. So what is saying that there was another thing which was happening before IBC regime. which was disturbing the whole market renewal process. And what that thing was, there was a very lot of difficulty used to come when any new firm want to exit the market. So it was very difficult for the new firm to actually the exit market. He says that the firm with the new investment on the basis of certain market expectation, in case those expectations are not realized, they need to be able to exit. The more difficult such a situation, the more reluctant the investor would be. So what he's saying, obviously, if a new firm is entering into the market, they will have some kind of a expectation from the market, and in case they will not able to realize those expectations, they should be and they must be able to exit the market. But this process of exiting was very difficult, and if this would have continually go to be very cumbersome or difficult, then investors or potential investors who are looking for the investing in the market or coming into the market will always refrain them from actually going into the market in the first place. So he is discussing about that this blunting of competition from inefficient potential entrants had the effect of propping up of inefficient and uncompetitive incumbent firms. So what it was doing is that it was doing nothing but refraining new potential entrants, or you can say the new fresh entrants from going into the market. By this, they were reducing the competition which could have bring by the new entrants, and started piling up, or started you can say that more inefficient and uncompetitive firms started spreading across the area. He says that furthermore, the large inefficient corporation often recognize the government would view their protected exit, during which the value of their asset would see deterioration, and the paucity of new entrants as socially costly. So the large firms which were inefficient used to says that government would recognize when they when their books would start falling, or they will start deteriorating. So even if the large firm who are defaulting, they will make a plan of exiting the market, government would not allow them, and even government would help them to sustain for the long term, because still you first refrain all the new participants from coming into the market. Now if even the large firms would exit the market, then there will be they would will totally destruction in the market. He says therefore during a downturn they credibly argued that unless the government rescue them, their entire sector and the wider economy would suffer. The threat of accompanying job loss sharpened this argument, obviously. So there were no new entrants in the market, and there was a potential loss if the large firm itself also exit the market. There would be a lot of the economy as a whole will suffer at a wider level, and obviously there when the large firms would shut, there would be thousands of even lakhs of job loss. So even so, keeping in mind these potential loss or the potential social cost was way more higher than the actual defaulting that was being done by these efficient firms. So they could actually leverage these high social cost in front of government and seek for their help, and actually demand that until the government actually helps us, we won't able to recover properly. And if you want us to go, we can go, but your economy would suffer very largely. So but things changed. Luckily, IBC has now considered speeding up the exiting process. He says that backed by a 2017 amendment to the Banking Regulation Act, it has also empowered, this is very important, also empowered creditors to pursue defaulting promoters. This result to this have been extremely encouraging. So what used to do earlier is there was a concept called a separate legal entity. So if a company A defaults, then the creditors would only get the money from the liquidation of the company A. So other than that, they won't be able to recover any amount. But in 2017, Banking Regulation Act brings a new amendment which allows the creditors to pursue even the defaulters after the liquidation of the firm itself. So that was very encouraging. But there is a certain conditions, like for who will be the actually the promoters that creditors could pursue, because they cannot pursue all the promoters. He says that he actually gives the example. He says that for example in 2017-18, Jet Airways was among the largest players by passenger shares in both international domestic aviation market. But when it defaulted on its loans in 2019, creditors could speedily inject its powerful promoters. Moreover, despite its size, its exit create minimal market disruption. Other airlines stepped in to fill the supply gap and are also picked up its employees. Loan recovery by creditors is well underway. So what he is saying is that he gave an example that in 2017-18, Jet Airways was a very large firm, is one of the very largest players in the aviation industry. But when in 2019 it defaulted on its loan, the creditors could speedily inject its powerful promoters, and even when Jet Airways default and exit the market. The other airlines stepped in very quickly and filled the supply gap. And because of this shutdown of Jet Airways, they picked up them as well. So there was no job loss. But he says that a loan recovery by the creditor is underway. So which means that they will actually get the recovery of their loan. He gives the other example, says that IBC has resulted in the entrenched promoters losing Bhushan Power and Steel Limited and Acer Steel, because these were the two cases that were first dealt by the IBC. He says that JSW Steel and Urson and Metal have respectively acquired these two firms, and he says that Bhushan Steels and Acer creditors have recovered 41% and 91% of their loans respectively. Okay, so now he goes on to the explaining that how much recovery process has gone has actually improved significantly by the introduction of this IBC code. This is that according to the rating agency CRISIL, during 2018-19, financial creditors recover 42.8% of the 2.53 trillion rupees amount claimed under IBC. This represents a market improvement over the dwindling pre-IBC recovery rates of 31%, 24%, 22%, and 18% that was in the 2010-11, 2011-12, 2012-13, 2014-13-14 respectively. Critically, CRISIL reported that the average time amount for resolution has declined from 3.5 to 4 years to 326. So the resolution period has also reduced significantly for the 94 cases resolved under IBC as of March 31st, 2019. Later he explains that given the new context, it is essential for the government not to subvert the competition by intervening on the behalf of a ailing corporation. When bankruptcy is swift, it does not result in the destruction of assets. Instead, it allows a more efficient player or buyers to acquire them at a price at which they can be deployed profitably. We have seen the example of Jet Airways. So what he's saying that government should not intervene in the market process by actually subverting or reducing the competition by intervening on the behalf of ailing firms or the firms which are defaulting. The government shouldn't act on their behalf or help them, because by helping them it is just disturbing the whole because by interfering in the because by you can say that because acting or helping the defaulting firm or the defaulting large firm is what I should say government actually disturbing the whole market environment. So government shouldn't do this, because if because they are saying that go bankruptcy is when bankruptcy is swift, it does not result in the destruction of asset. He's saying that given the fact the bankruptcy itself was swift, it will not actually destruct the asset. Instead, it will allow more efficient buyers acquire them at a price at which they can deploy profitably. So what is saying that it will actually allow new efficient buyers or the firms to enter into the market, and they how can then they actually enter into the market? They can actually purchase the asset of the defaulting firm at a reasonable price, and by entering and using the asset that they have bought. And lastly, he says that what government needs to do is make IBC more speedier, more transparent, and hazard free. As an example, it is reported that after JSW Steel acquired Bhushan Steels, that enforcement directorate attached the firm's assets against its claim on such overreach by government agency has a chilling effect on all potential bankruptcy resolution. So what he's saying that the government what needs to do is that make IBC more speedier, more transparent, and hazard. And he give one very strange example. He says that when actually JSW Steel has acquired Bhushan Steels, this agency enforcement directorate actually attached the firm's asset or the Bhushan Steel's assets against its claim. So what that mean is actually when JSW acquired Bhushan Steel's asset, now they would have to pay liabilities that were attached to the assets. So obviously that created more burden on the part of JSW, because they didn't expected that they while acquiring assets, they didn't expect that they would have to also pay the liabilities that will be going to attach to the assets as well. He says that it is reassuring that the cabinet has recently approved an amendment to IBC protecting buyers of asset against such liabilities. So we have some relief that recently cabinet has approved an amendment in the IBC that this thing will never happen again. So they would not have to pay the liabilities that will be against to the assets acquired by the new buyer. Parliament must swiftly pass the amendment, but Parliament has to pass the amendment. So there are some changes that the government has to do to make the resolution process more stronger, and we are saying that actually when the firm defaults, it doesn't or actually go bankrupt. Even if it is a large firm, it will not be that much you can say that much harmful for the environment as per se, and will actually will be filled by their the void that will be created after their exit will be some will be covered by, will be filled by some efficient players, and things will actually recover. And how, and this is how indian this is how a financial system, financial environment works. You know, all the defaulting firms will keep on exiting, and all the good firms or the efficient firms will start coming up and taking the environment and making it more efficient. So I think that's the whole article, and now I'm signing off.